The Property Bulletin by London Property, the home of superprime.
New research by Lichfields has found that co-living developments are on the rise in London and can offer a modern solution to the capital's housing challenges. The report, titled A New Way to Live, Co-Living in London, highlights the sector's ongoing growth and benefits while calling for greater policy support to ensure its long-term success. Whilst only 25% of London boroughs have adopted or are developing planning policies which explicitly support co-living, the sector is thriving. Of 34 large-scale co-living planning applications submitted in London to date, nearly 70% have been improved. These schemes cater to a wide range of people, including young professionals, seeking high-quality, affordable and community-focused living spaces, with developments typically featuring private rooms of 20 square metres and generous shared amenities averaging 5.5 square metres per unit. With traditional housing delivery faltering and planning applications for residential schemes in decline, co-living is emerging as a resilient alternative and one which can deliver considerable local benefits, including affordable housing. Adam Donovan, planning director at Lichfield, said, "Co-living represents a fresh approach to urban living, offering high-quality, flexible housing that meets the needs of Londoners today. It's a way for local authorities and the Greater London Authority, GLA, to meet housing targets and address the broader housing crisis. However, misconceptions still cloud the sector's reputation. Co-living is not a stopgap solution. It's a forward-thinking, community-focused lifestyle that deserves its place in London's housing mix." Despite its progress, Lichfield says that co-living faces barriers, and it is often misunderstood. The findings emphasise the need for a collaborative approach between developers, policymakers and communities to ensure a co-living becomes a fully integrated part of London's housing strategy. Donovan continues, "The sector is still embryonic, and many stakeholders, councillors, planning authorities and communities don't fully understand how it works or the benefits. Too often, co-living is mistakenly lumped in with HMOs or short-term lets, but it's anything but. These are thoughtfully designed spaces that foster community while providing private, high-quality living arrangements." The research stresses the importance of demystifying co-living to ensure its success. Educating decision-makers about the design quality and community benefits of these schemes is critical to addressing misconceptions and unlocking the sector's potential. By addressing policy inconsistencies and dispelling myths, the sector can continue to grow and contribute meaningfully to London's housing landscape. Donovan adds, "The conversation about co-living needs to shift from debate to action. It's time to embrace this innovative housing model and integrate it into solutions for London's housing crisis." New research is highlighting the impact of tenant-driven demands, regulatory challenges and smart buildings technology on the commercial real estate sector, with 66% of landlords reported to be reconfiguring property portfolios. According to the report from LMG entitled "Smart Moves: How Landlords and Tenants Thrive in the Evolving CRE Market," 70% of UK commercial real estate (CRE) leaders are concerned about economic pressures, while tenant demands and sustainability expectations are driving unprecedented market shifts. The report underscores the urgency for landlords to modernise and adapt, with two-thirds admitting they are not fully compliant with current regulations. LMG's research, based on insights from 50 UK CRE owners, highlights how evolving tenant priorities are redefining the market. Demand for hybrid workspaces, shorter leases and eco-friendly features is outpacing traditional requirements. Two-thirds of property owners are reconfiguring portfolios to serve the booming flex workspace market, while 42% are upgrading assets to attract global headquarters tenants. The report also sheds light on regulatory hurdles, with an estimated 80% of London's commercial buildings at risk of non-compliance under upcoming minimum energy efficiency standards legislation. Despite full awareness of regulatory mandates, two-thirds of landlords remain unprepared, risking hefty fines and tenant dissatisfaction. Tenant demands are not only driving operational changes, but also reshaping the landlord-tenant dynamic. Airbnb is expanding its subletting rules to the UK, allowing tenants to sublet properties with landlord approval. This initiative, previously launched in the US, now includes a partnership with Greystar to make 1,500 homes across the UK available for subletting. Prospective tenants must sign contracts with landlords that outline subletting rules, including a revenue-sharing agreement where 10 to 25% of subletting revenue goes to the landlord. Gary Hall, head of lettings at Knight Frank, warns that without proper verification, landlords could face unauthorised property listings. He stresses the need for robust security measures beyond just the landlord's signature. Airbnb's global head of real estate, Jesse Stein, acknowledges that many tenancy agreements prohibit subletting, posing challenges for renters wanting to become Airbnb hosts. Landlords participating in the programme are satisfied as long as the flats remain primary homes. Airbnb plans to extend this programme to other parts of the UK to address the criticism that short-term lets are reducing available housing stock. Maria Hatch, Senior Director at Greystar, is optimistic, citing the success of the US partnership and highlighting the financial flexibility it offers residents. The Westminster Legal Policy Forum indicated that leasehold reforms, as scheduled by Housing Minister Matthew Pennycook, will likely proceed, but the introduction of common hold remains uncertain. These reforms follow reports by the Law Commission, led by Professor Nick Hopkins, who also spoke at the conference. The event was chaired by Lib Dem Baroness Thornhill and attended by various stakeholders, including the National Leasehold Campaign, the Residential Freeholders Association, estate agents, conveyancing lawyers, property managers, lenders, and leaders of the Common Hold Now campaign. Sebastian O'Kelly of LKP addressed the implementation of the recently announced reforms. He noted the widespread frustration among leaseholders facing increasing service charges, insurance costs, and major works imposed by freeholder-appointed managements. This issue, often highlighted in the media, exacerbates the cost of living crisis and represents wealth erosion under the current law. O'Kelly criticised the feudal nature of the leasehold system, calling for its end as declared by the government. Key issues include consultations on secondary legislation to the 2024 Act and the primary legislation required for enfranchisement. The government's stance on existing ground rents, following a consultation initiated by Michael Gove, remains unclear, especially regarding the potential reset to zero. Other concerns include marriage value, the deferment rate, and the development of a government online calculator for enfranchisement costs. The end of leaseholders paying landlords legal costs is also anticipated. Despite scepticism about the government's ability to implement these reforms, O'Kelly expressed optimism due to the competence of Housing Minister Matthew Pennycook and supportive officials. He advised against buying new-build flats unless developers offer share of freehold, membership in a residence management company, and a path to common hold ownership. Notably, McCarthy and Stone recently supported common hold, suggesting other house builders might follow suit. Additionally, Homes England should ensure Help to Buy grants are only given for flats with leases rewritten to reflect these new realities. London continues to be a magnet for the world's wealthy, home to 230,000 millionaires and a hotspot for high-end residential properties. Despite the government's decision to abolish the non-dom tax regime, the city's allure remains undiminished. CBRE's inaugural Luxury Real Estate Report highlights a surge in demand across three residential categories: luxury, ultra-luxury, and exceptional. Over the past 3 years, 60% of households were at the luxury price point, £1,440 per square foot, a decrease from 70% between 2014 and 2020. However, sales of exceptional properties, £3,090 per square foot, have more than doubled from 8% to 17%, reinforcing London's status as a global hub for luxury living. The UK has historically attracted overseas buyers due to its favourable remittance basis tax regime, contributing to high real estate prices in London, £2,320 per square foot, compared to cities like Paris and Amsterdam. While Amsterdam has become popular due to tax advantages for expatriates, the UK government aims to keep the UK attractive for ultra-high net worth individuals, UHNWIs. However, recent changes such as the rise in inheritance tax and the abolition of the non-dom tax regime from April 2025 could have implications. From April 2025, new UK residents who haven't been tax residents in the last 10 years can bring their offshore income and gains to the UK tax-free for the first 4 tax years. Non-DOMs already in the UK can use the Temporary Repatriation Facility to remit foreign income and gains at a reduced tax rate. Additionally, exempting second homes from changes to capital gains tax could boost investor confidence, although higher stamp duty on second properties may deter some investors. London remains a prime focus for investors, recognised as Europe's financial centre and a leader in various industries. CBRE's sales data indicates a 33% increase in total gross development value for agreed sales this year, with luxury transactions concentrated in affluent boroughs like Kensington, Chelsea and Westminster. This consistency since pre-pandemic times underscores the city's enduring appeal. London's resilience and appeal as a luxury residential destination are evident, but it must continue to bolster its status to maintain its position as the top choice for HNWIs. Any loss of interest from wealthy individuals could lead to a decline in personal and business investment in the capital. The future impact of government policies on HNWI interest remains to be seen, but London's distinct position in the global residential real estate market is clear.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.